as the saying goes, you should not be putting all your eggs in one basket. So rightly it has been said. If you're putting all your eggs into one basket, in case something goes wrong, you'll be losing out all the eggs in the process. So therefore, it is always advisable to all the businessmen to take clue from this particular saying and not to invest all of your capital into one particular business so as to eliminate the probability or of loss making in a particular single business. Okay, so hi, I'm Professor P.K. Pathak, and today I'm going to take up the topic of the portfolio analysis as promised earlier. So more importantly, it is about the portfolio management because a wise businessman is well aware of the fact that in the business dynamics, there is a lot of risk associated with all kind of the business activities that are being taking place in day-to-day basis. So that's the basic phenomena that we are going to have a discussion, and after discussion, you'll be able to establish first of all as to what exactly the portfolio analysis is and how you should be making a decision about investing all of your capital into multiple business activities. So we'll be having a discussion, and before that I share my slide. I'll request all of you to just like, share, comment, and subscribe to my YouTube channel, and keep on receiving such fabulous and knowledge giving videos. Okay, so on that note, now I start sharing the screen. I hope the screen is visible to you. Okay, so this is the topic of the day. We are going to have a discussion on the investment portfolio. So what is portfolio for that matter? Portfolio हम कहते हैं एक combination of many kind of businesses under one particular umbrella. Okay, so let us know the facts associated with the portfolio. As the book's definition goes, portfolio is a collection of the financial investments like the stocks, bonds, commodities, cash and cash equivalents, etc. So all of you know what is the stock. Stock is basically buying of the shares, and those who are not wanting to take risk, they can go for procuring the bonds, which are comparatively safer. They can also invest in some sort of commodities in inventory building and all. They can keep some cash or cash equivalent with them in order to ensure that they have enough money to cater for day-to-day requirements of the business. Okay, and the closed-end fund and exchange traded fund, the differentiation has already been mentioned here. That in a closed-end funds, only one time the shares are issued, and no more cash inflow will be taking place thereafter. Whereas in case of the exchange traded fund or the open-ended funds, you can reissue the shares in order to procure more amount of money. Okay, so these are all some of the inputs you must know about them while discussing about the portfolio. Okay, so let us understand what is the portfolio and how you can mitigate the risk associated with the in the business process decision making. But diversification is what? All of you should know diversification simply means that you are doing additional business apart from your core business activity, in case you were having only one business activity at the point in time. So when you are adopting to some new business methodologies and creeping into new business fields, so that is what is the act of diversification, and you can definitely mitigate the risk or eliminate the risk simply by diversification. Because what happens is, suppose you are having a combination of multiple business activities, multiple business investments. So because as you know that the market is all about risk, and there is always a risk associated with any and every business. So what is the wisdom you are displaying here is, since you have invested in multiple business activities, it will usually not happen that all the businesses are incurring loss at a single point in time. Okay, so while some of the business activities may incur some losses, the other business activities it will be evolving profitability for you. So in the process, what will happen, you will be fairly comfortable with all your business, and the loss is not going to have much impact on your business process. Okay, So you need to be very careful in building your portfolio in terms of the percentage of the investment you are going to make out of the capital. And definitely there are a few factors which do have an impact on the building of the portfolio. I mean, your selection of as to where you are going to invest actually your capital amount. So these are some of the factors like your goals for the future. Every business has got a different goal of the future. Some people have short-term goals, some people have long-term goals, some people have the visionary requirements, some people have, the short-term profit-making, goal. So depending on your particular goal, you are going to go with the portfolio investment. Then next is your appetite for the risk. How much risk you can take? Because as the saying goes, no risk, no gain. More risk, more gain. So while the people are investing in the market, they are actually taking a lot of risk. So the degree of risk that you can take, it will decide how far you can go in investing in a particular business. And ultimately, your personality, your outgoing, your versatile, you're courageous, all kind of these attributes of your individual personality is going to define how you take the things. Because also what matters is some people may think something as a risky, but simply sheer because of your attitude, you think this as an opportunity. So the personality have an impact on the interpretation and perception of the arising business situation as well. Okay, so these are all some of the factors. चलिए आगे बढ़ते हैं. This could be in sample assets allocation. So suppose you have 10,000 rupees. So as you can see, these are some of the options available to an individual. So in this particular case, as you can see, almost 35 to 40% of the investment is being made in the stock. I mean buying the share. Okay, and mutual fund also almost it appears to be 25%. Similarly, the bonds also bear an amount of fair percentage, and remaining is the cash. So this individual wants to keep at least 10 to 15% of his capital as a cash or cash equivalent. So this is one of the sample asset allocation. This is again depending on the various factors as discussed in the previous slides, and depending on your own appetite to risk and the personality factors, you can decide on where to invest. So this could differ from each business person. Okay, so this is just to make it clear to all of you that this is a pie chart in which some percentage has been allocated by the businessman in the process. Okay. Let us see further. These are the types of the portfolios. The hybrid portfolio means, as the sample I have given, so this investment is being made in multiple business activities. It may also extend to the real estate business. While a portfolio investment is basically in the share market, the huge amount of money will be invested in the share market. The third one is aggressive equity focused portfolio. These are the people who are quite aggressive. They want to make huge amount of money in short period of time. So they identify some of the startups who may not be in position to bargain to their advantage. So what these people do, they pay them less and acquire a lot of equities out of their business, and they anticipate that profitability will happen. But then there is a lot of risk associated as well, because the startup may not flourish the way they wanted or the way they anticipated. The defensive equity focused portfolio, on the other hand, they invest a lot of money or major amount of their money into the consumable items, so that even in the worst possible case of the economy, the items gets consumed by the people. Like the tables and the general use items, or the FMCG, more importantly, you can call it the fast moving consumer goods. So these are the people, they usually don't make any loss. Then there are an income focused and equities portfolio. So they are a little bit of having the systematic mindset, and they are studying a lot about the market, and then they make systematic investments, so that they are getting regular incomes in the process. And finally, the speculative ones, who make all kind of speculations on day-to-day basis on the way, on the inputs received from the share market. and some sort of intuitive decisions also are being taken by these people, and they sometimes they happen to gain a lot in the process. So these are some of the types of portfolios. So again, depending on the kind of risk that you can take and the opportunities available in front of you, you can choose to build your own portfolio. Okay. And what is risk and return? I told you earlier that if you want to have a better return, you need to take more risk. So what is risk and what is return? Let us be very clear on that. These are some of the specified risks when a person is investing in the markets. You can have a project specific risk. Whatever project you have taken up for investment, that project itself is going at loss. The other one could be industry specific risk. Whatever industry you are operating in, if it is going down and there is a lot of reduced demand for whatsoever reason, then you are going to face a lot of risk on that. Competitive risk is when your competitors or the rival companies, they are beating you and they are coming with a better product than you, have an aggressive marketing, and they have got a better outreach among the consumers. International risk could be arising out of multiple factors, and one could be the entry of the international producers. And market risk is overall market risk. It's with the share market, it's with the financial market, it's with the consumer market. So all these combined together, you may face some market risk as well. So these are some of the risks which a businessman has to face or an investor has to face. And why he's facing all these problems? Because he wants a higher return for his investment. So what is the return? Return refers to either the gains or losses made by trading a security. Okay, and this is always expressed as a percentage. So suppose you have invested 10,000 rupees and there is a 10% return on the investment. This simply means that you have been getting a profit of rupees 1,000 on the investment of 10,000. Okay. So I hope now the things are amply clear to all of you. Finally, we'll sum up the whole topic. Diversification reduces or eliminates the firm specific risk. I already have explained this to you, that if you are keeping your investment in multiple businesses, all the businesses will not go at loss at the single time. Okay. And so once again, let us see, this is a pie chart. You can make your own investment portfolio in terms of the cash, property, bonds, stock, real estates, and many more. Again, depending on your own specific requirements. So that's it for the day. I hope the things are amply clear now to all of you. You have got a better understanding of the portfolio. And in case you got certain doubts, or in case you want certain more explanations on new topics or even on this topic, you can just write in the comment box. I'll be happy to note that, and I'll come out with more explanations or related explanations in the process. Okay, so that's all for the day. Thanks a lot for watching the video. Do like, comment, share, and please subscribe to my YouTube channel. That gives a lot of motivation to prepare more interesting videos like that. You can get connected with me on this particular email ID. Just write whatever is feeling about the subject, or if you want some more guidance. I'm a management expert as well, so I can advise you on many forums. Okay, so that's all for the day. And once again, thank you very much for watching this video. Be in touch, be connected, and we'll be back soon with a new video on a very, very relevant and important topic. So thank you. Thanks a lot.